Good afternoon. I know this is a burden to hear a keynote speech just on the heels of lunch, and I tried to persuade Louisa to give everybody espresso, so maybe this will kick in as I begin and as I go through my presentation. I'm really delighted to be here in Cape Town, particularly because I just heard a few hours ago that it's snowing back in Washington, so my family is quite envious that I'm sitting here in a climate of 80 or so degrees Fahrenheit. Interestingly, the natural resources sector, particularly oil, is where I began my career 35 years ago. And in fact, my doctoral dissertation in economics was on the state of competition in the natural resources sectors, and in particular, oil and the rise of OPEC. Ironically, that work, my doctoral thesis, coincided with my father leaving the chemical industry where he had been employed for 35 years and moving over to the oil industry. He wasn't particularly pleased with the kinds of analysis that I was doing, which showed that, at least at that juncture, with the continued presence of the Seven Sisters and the nascent beginnings of OPEC, that I had written a thesis on the lack of competition in the industry from which he was earning his income. And that's, frankly, when the source of my gray hair began at that age. But, you know, I guess what's very important to state at the outset is I'm here from Washington, and like most people from Washington, I'm here to help. And actually, speaking of Washington, as you know, we are just in the throes of a presidential campaign. It has many similarities, I would argue, with the cyclical nature of the mining industry and natural resources, in the sense that it is a regular occurrence, it is usually too long, it is usually very painful. And after each presidential campaign in the US, which lasts far too long, and after each cycle in the metals and minerals industry, which we think is too long, we all say to ourselves, never again. But I think this is the world in which we live in. And what I want to do is focus my remarks today on identifying what are the fundamental changes underway in emerging markets within the world economy and how that shapes the opportunities and risks of investing or receiving investors in the mining sector. And I want to obviously focus a lot on what is going on in sub-Saharan Africa. What is important, I think, to recognize is that there is still underway a process that began at least a decade and a half ago of a fundamental structural transformation of the world economy. The world economy is really moving at two different speeds. And this is a secular or structural transformation in the world economy. And what we are living through is that continued structural change, and superimposed on that are business cycle and cyclical changes. And it's very important, I think, when we think about the minerals industry and the opportunities and the risks associated with it, is that we are living in this environment that is a combination of very significant upheavals in the basic structure of the world economy, but on the edges and coloring that secular trend are cyclical. And it's important to make that distinction. And if you don't make that distinction, I think your investments, and if you're a policymaker, your policies are going to be falling very short of what your aspirations are. And what I think I want to do, start before I look at what are the particular risks and opportunities in the emerging markets, and in particular in Africa as it relates to mining and mineral resources, is to look at what is this bifurcation of the world economy. And in very brief terms, the emerging markets have been growing for the last decade and a half, if not 2 decades, at a rate of growth that is 2 times the rate of growth of the advanced countries. And I think when many people look at the numbers, they're quite surprised at this gap. And not only has this gap been quite consistent over the last decade and a half, but in some cases it's actually growing. And so when you look at the numbers, which I often do as a matter of course for clients and for my role at Johns Hopkins, the advanced countries in 2015 grew just below 2%. Meanwhile, when you look at emerging markets in 2015, the year that has just closed, their average growth was 4%. So that's above a factor of 2. In 2016, the year in which we are now existing, the rate of growth of the advanced countries is going to rise just slightly to 2.1%, yet emerging markets in 2016, according, for instance, to the International Monetary Fund, their rate of growth is actually going to be higher than it was in 2015 at 4.3%. Again, higher than a factor of 2. And then when you roll the camera one more year ahead to 2017, what you find is that the advanced countries are predicted to continue to still grow around 2.1%, not a change from the previous year. But the emerging markets as a whole are going to grow even faster than before, up to 4.7%. So I think it's very important to understand that this is not just something that has occurred within the last 3 years. This has been going on for almost 2 decades. Now, one of the implications of the fact that emerging markets are growing much faster than the advanced countries, and again, I think for many who don't spend a lot of time looking at these data become surprised, emerging markets are in fact driving the growth of the entire global economy. So if you think of the global economy as a pie, the share of the pie that is going to emerging markets is actually getting larger and larger every year. In fact, just this last year, emerging markets accounted for 60% of global GDP. Just a decade ago, it was 50% of global GDP. But even more telling is that when you look at the rate at which the economy is growing, the global economy is growing, that is to say, as the pie gets bigger, what is happening is because of the emerging markets growing so fast on average, is that their slices of that growing pie are actually getting bigger at a faster rate than the slices of the pie going to the advanced countries. And so when you look at it from that perspective, on the one hand, they're accounting for 60% of global GDP at a snapshot. But over time, what is now happening is that 85% of the growth in the global economy is being engendered by emerging markets. So this is what, those of us who study this is what we mean by the fact that emerging markets are driving the world economy. In fact, the linkage between what is going on in emerging markets and the advanced countries is quite robust. If there is a 1% increase in growth in emerging markets, that leads to 0.2% increase in the advanced countries. So they're intricately linked. But if you did this exercise 2 decades ago, the situation would be almost reversed. And I think not understanding this fundamental transformation of the world economy means that you don't really understand what is going to be driving risks and what are going to be driving opportunities as the years go forward. Now, if the proposition is correct or true that emerging markets are the engines of growth in the world economy, that means that policy attention and the attention by investors in order to continue to have the global economy grow has got to be focused more and more in emerging markets. It's not the case that we can hope for the advanced countries to help ramp up and increase the size of the pie. It's almost akin to what U.S. Defense Secretary, former U.S. Defense Secretary Donald Rumsfeld said, which is, you cannot fight with the army that you wish you had, you've got to fight with the army that you have. Well, we're in the same situation. If growth is emanating from emerging markets, this is where the action will be. And that's why we are seeing private equity funds, corporates, sovereign wealth funds increasingly focusing on the emerging markets rather than on the advanced countries. Now, I know, throughout the Indaba, there's obviously tremendous concern about the softness in commodity prices, particularly in minerals and metals. But I think the situation that we are in today, as I have suggested, is a cyclical problem superimposed on a secular trend. And what's critical is to distinguish what is giving rise to the cyclical problem today, because that's going to color how you interpret where are the opportunities come from and how should you avail themselves and how should you mitigate the risks. So this is not, the softness today is not reminiscent of the crisis in emerging markets that took place in 1998, where that was driven largely by sovereigns taking on foreign exchange denominated debt and having inflexible exchange rates. That's just not the case today. Most sovereign debt today is denominated in local currency. And it's unlike the crisis, the financial crisis in 2008, which was characterized by imprudent regulatory actions on the part primarily in the initial stages by the advanced countries, and then that seeped over to the financial sector in the emerging markets. That's not, again, what we are facing today. In fact, when you look at the amount of cross-border banking within emerging market countries, it's become extraordinarily limited since the financial crisis of 2008. Moreover, while there is an incidence of corporate debt in emerging markets that is becoming larger, a little known fact is the type of debt that corporates in emerging markets are taking on are less and less loans and more bonds. And that is injecting greater flexibility into dealing with the debt situation on the corporate side. But again, the sovereigns, most sovereign emerging markets today do not have their debts denominated in foreign currency. So I think when you look at how the emerging markets have fared, particularly in the 2008 crisis, by and large, and I've done some work on this relative to Africa, The most resilient economies of the world during the 2008 financial crisis, guess what? They were Africa. The African policymakers were smart. They learned from the hard-won reforms that were put in place for the previous decade, and where you saw governments put in place or try to put in place price controls or protectionist measures to try to insulate and inoculate their economies from what was going on in the world economy, didn't happen largely in Africa. It was in Russia, it was in Turkey, it was in some Latin American countries, and I dare say it was even in some advanced countries. And when I look at a country or a set of countries and I look at how the policymakers react to exogenous or external disturbances, that's what I think one needs to focus on. And in that regard, generally speaking, the African policymaking framework is far more robust than most other emerging markets in the world. And in particular, when one looks at China, which is clearly the $1.3 billion gorilla in the room, so much attention is focused on the fact that there is a decline in demand for commodities and other products in China. That's true. But where I believe the faulty analysis lies is that this is not largely the result of a cyclical downturn in China. What is going on in China is a very serious structural problem. It's a country I've been working in since 1993, and the problems that we are seeing today in China, yeah, to some extent they're a little bit of a cyclical nature because the business cycle is not dead anywhere. But what is driving the problems in China are systemic, stemming from basic contradictions in the fabric of an economy that continues to pursue Deng Xiaoping's dictum of a socialist market economy. And if you think about the juxtaposition of those two words, they in themselves suggest that there is a contradiction at work. And what's been happening is that contradiction is now coming to the fore. And so just to give you a couple of examples, we've got the state-owned enterprises which have become larger and larger and have migrated to heavy industry, and you've got the non-state sector, the so-called private firms, which are left to grow fast, but in the light manufacturing sector. But the state-owned enterprises are borrowing, in quotes, from the state-owned banks, and they rarely repay their loans. And so to build on sort of an old Soviet type of expression, the banks in China pretend to lend to the SOEs, and the SOEs pretend to pay back the banks. And perhaps the most glaring contradiction, I think, is what is going on in China's so-called stock markets. These are not markets in any economically meaningful sense of the word. The party made a decision, rightfully or wrongly, for the citizenry to be able to share in the growth of the Chinese economy. And so you have lots of new entrants, not just listing companies, but new entrants in buying and selling shares. But they didn't understand that in a real market, when the share values went down, you lost money. Well, that's not tenable in a place like China, which depends heavily on maintaining Social Security, and so the government steps in and props up share values. That's another contradiction in term. And finally, the Chinese are very vocal about reorienting their economy to a consumer-oriented economy. I'm sure they want to do that, but the problem is that the party has a chokehold on the industrial side of the economy and does not want to let go of that. And so when you look at the household consumption in China as a share of GDP, it's 1/3. You're not going to be able, on the basis of 1/3, to transform an economy from an industrial-oriented to a consumer oriented. In the United States, for instance, household consumption accounts for 2/3 of GDP. Very big difference. So I think what's going on in China, to be sure, is a little bit cyclical, but it's a far more serious problem than I think most people understand. Let me turn to the opportunities and the risks of investing in emerging markets, and in particular in the mining sector and in sub-Saharan Africa. And I think there are 2 points at the outset on thinking about opportunities and risks and how do you identify them and how you measure them. The first point is, generally speaking, most people misperceive what are the real risks and what are the real opportunities in emerging markets. And the 2 examples that I like to use is sub-Saharan Africa and China. And in many meetings that I've had over the years, when I talk to CEOs or senior vice presidents for strategy about what their plans are for growth, I would say, well, how do you judge the risks of investing in China versus the risks of investing in Africa? The vast majority say, oh, the risks of investing in China are much lower than the risks of investing in Africa. And I think that is fundamentally upside down. That when you roll up your sleeves and you go into China and you look at investment opportunities, which I've done many times with clients, you come away, and I know this country very well, you come away thinking, I cannot identify who the ultimate beneficiary is. In many African countries, it's not as if it's readily apparent, but you can find that answer pretty quickly. And so the misperception of risks and opportunities, where in some cases the risks are artificially overstated and in other cases they're artificially understated, is a big issue. And understanding how to pierce through those misperceptions is the first battle. But I think a more important problem in identifying and optimizing against opportunities and risks in emerging markets is that the nature of those opportunities and the nature of those risks, what is driving them, is changing. And it's changing precisely because of this bifurcation of the world economy I mentioned at the outset. So what are some of these changes in the opportunity risk set that we see in emerging markets, and in particular in Africa? Number one, there is an increasing role of South-South investment and trade. That is to say, trade or investment among emerging markets. 15, 20 years ago, South-South trade accounted for less than 6 or 5% of world trade. Today, it counts for more than 20%. And the rate of growth of South-South investment and trade is twice as fast as trade and investment between the advanced countries, and also much faster than the traditional path of investment and trade from the north to the south. But what this means is that companies investing in emerging markets are facing new rivals. It's not the case anymore that GE is worried about Siemens and Siemens is worried about GE. They're both worried about the Chinese. They're both worried about the Indians. They're both worried about the Brazilians. So there are distinctly different rivals. And moreover, many of these rivals compete on different terms than what the advanced country firms are able to compete on, either because they're not subject to the same kinds of restraints on corruption, or they disregard WTO rules regarding subsidization. So one of the issues is, how do you deal with that risk? And one of the things that the Chinese and the Brazilians and the Indians have done, because they themselves are from emerging markets, is they realize when they go into a market, yeah, they may or may not compete on price. But what they do very ingeniously is they compete by coming in cross-sectorally. If they're a mining company, they're not going to come in just to develop a mine or process and smelt metals. They're going to come in and bring a hospital and bring a rail sector. And that's very smart because the markets in which they're making these investments have, in fact, cross-sectoral economic development deficits. I would submit that investors thinking about coming into Africa or expanding into Africa and other emerging markets in the mining sector have got to think about teaming up with like-minded firms in complementary sectors to mining. There's no point in trying to underprice the Chinese. That is a losing battle. But you, I think, would be surprised at the receptivity on the part of investors within the emerging markets, and in particular in Africa, who want to have world-class investors here. And if they were to come in arm, cross-sectorally, that would be a far more efficient way and effective way of winning that place in the market. The second, I think, change in the opportunity-risk trade-off in emerging markets is, and we all know this, is the rise or the continued pronounced presence of the state in the economy. But what has changed is often the role of the state in emerging markets has shifted from an explicit role to an implicit role. And it could be through creeping expropriation, it could be through increased taxes. But the way that I have worked with clients in mitigating that risk is to put together public-private partnerships that explicitly bring under the tent the government, whether it's local officials or whether it's federal or central officials. Once they feel that they have a stake in the game, they will help you inoculate the project from risks from competitors or other vested interests trying to topple it. And so the simple point here, from my perspective, and as I've been working with clients, is what I would call the client shoe principle. Put yourself in the shoes of governments in the emerging markets, and what are they wrestling with? They're wrestling with a lot of problems that clever investors can fashion win-win strategies for, that they profit very well, as does the host government. And I'll just give you, several of these. Clearly, there's underdeveloped infrastructure in many emerging markets, in particular in Africa. Not just is there infrastructure missing, but the quality of service, the reliability is poor. So what would prevent mining companies or other companies coming in and, as part of an investment, teaming up with a like-minded company to bring in electric power generation or distribution, or bringing in some kind of transport infrastructure, not only to serve their particular investment, but as part of a profitable way of addressing what is a gap in the market. And this is a very alien concept, I'm finding, at least among advanced country firms. They only stick to their sector. But I'm telling you, that is not the way the world is turning out in emerging markets. A second idea on this regard is another problem that the governments face in Africa and emerging markets is the lack of regional integration, because Africa, as we know, is cursed by the fact that it is comprised of a large number of landlocked countries, each of whom are small. And so, like what happens in other regions, is the authorities want to create synthetically large markets through regional trade agreements. But those trade agreements may or may not have much impact on the market. But what it does mean is, as a firm investing into these emerging markets, think carefully about how you might structure your investment to have multi-plant facilities across different jurisdictions, so that you begin to foster, not only for your own business, but for the sake of these economies, a degree of integration much faster than trade agreements in and of themselves are going to engender. And by the same token, another burden that we all know that African countries face is the vast bulk of exports are continuing to be raw materials. They're not processed. By the time they reach the port or the airport to be sent out, they are still often in the raw material stage rather than having extracted value added on the continent and then exported. This is one of the curses of Africa. And it just strikes me that one can negotiate a deal, as I have been doing with some clients, with governments, to say, we are willing, in fact, we can do this profitably, but not only mining and producing raw materials, but we can actually refine them and then export. And so you're solving a problem that the government has, and that also benefits you at the same time. And by the same token, there is limited, although it's growing, limited access on the part of African countries, particularly in the extractives, of engaging in network trade. That is to say, the African firms do not have the ability to engage in intra-firm trading through vertical integration and the like. And one of the things the Chinese and the Indians have done, and I've written a book on this, and I've looked at the data, is they actually put into their intra-firm channels the production that they are undertaking in China and bringing it to the international trade network through their firms. Again, you're solving a problem that really is bedeviling these governments. So the firms, the investors can actually do a lot to begin to ameliorate some of these burdens. As I say, it comes from this old dictum as a consultant of putting yourself in the client's shoes. And what can you do that is both profitable to you and profitable to them? And that's the way you're going to compete more forcefully against the new rivals that are coming into these markets every day. A third change in the organic fabric of emerging markets, and in particular in Africa, is that consumption decisions or purchase decisions, whether we're talking on the part of a government agency in procurement, we're talking about a business procuring inputs or procuring distribution channels, or we're talking about even at the retail level. Those purchase decisions in Africa are increasingly becoming more and more sophisticated. It is the case, and I've done a lot of work on this, that African consumers, again, whether it's at the government or the firm or the individual level, realize more and more that it makes no economic sense to simply buy the cheapest thing in an out-of-pocket sense off the shelf. What they are doing is they are making the calculation on a life cycle or present value basis. And so I can remember talking with some ministers of agriculture in some African countries who now realize 5, 10 years down the road that they bought the cheapest tractors, 10, 20 of them, from China. And I'm not belittling China, but the fact is that those tractors, after 5, 6, 7, 8 years, fall apart, and you cannot get parts for them. And the agricultural ministers, in essence, sort of smack their head and go, I should have bought the John Deeres. They were more expensive out of pocket in the beginning, but over their life cycle, in a present value sense, this is a far better investment. And we are beginning to see that happen in spades in Africa. And most people who don't understand Africa and don't give credit to the rationality of the behavior and incentive structures in any emerging market, whether it's Africa or not, that is occurring in Africa. And I think it's very important when you try to produce, when you try to invest in your sector in Africa, continue to concentrate on delivering quality items, and even if they're more expensive than the competitors, over time, the consumers, again, whether they're government agencies or businesses or individuals, will come around. And in this book that I mentioned before, we did some analysis on a sector which is not really akin to the mineral sector, but it's an extraordinarily telling story. And that is that we studied the market for blankets in the kiosks outside of Johannesburg. This is 5, 6, 7 years ago. And what happened was that the Chinese came in and began to produce these blankets, sold them for very cheap prices on these stalls, and they sold like hotcakes. Well, it turns out that after 1 or 2 washings of these blankets, they shrank, the dye ran out, and they began to disintegrate. And so the domestic consumers began to refer to these Chinese blankets as the wash and cry blankets. They were so cheap, but the light bulb is going on saying, I should have bought something of a better quality. Who comes in? But the Indians. And they start populating their stalls with blankets that are far more durable. They don't shrink, the dye does not run out, but they charged a higher price. And they basically eviscerated much of the Chinese blankets in those stalls. And that's a very powerful metaphor for what is going on in these economies in the emerging markets, and I would submit particularly in Africa. 2 more, I think, points I want to make about how opportunities and risks are changing. It's very clear that the NGO community in emerging markets, and in particular in Africa, and particularly in the extractives, are demanding good governance, are demanding good corporate citizenship. And what I have begun to see is that the traditional way of responding to these types of demands is to put in place corporate social responsibility or CSR projects. And the problem is that in most companies, CSR or corporate social responsibility projects are off to the side. They're run by a foundation, or they're run by somebody, in the basement of the headquarters of the company. And they're not integrated into core corporate strategy, but it should be. And not only should it be because it's going to increase your bottom line and your top line, but there are now some pretty celebrated stories because CSR initiatives were either an afterthought or off to the side. No one kept track of the money. And so I'm sure you know of these cases of oil companies who have put a lot of money to fund a school in Africa, $300 or $400 million. 3 or 4 years later, guess what? No school. No one knows where the money is. They're now under FCP investigation for corruption. But they were trying to do good in the first place. These are the kinds of risks that I think one has got to look at very carefully, and as I have said, is to reset the corporate responsibility button. And then finally, corruption risks. It's very clear that corruption is certainly present in Africa, just as it's present in every other emerging market. And dare I say, maybe even present in my country, the United States. But I think one of the problems I continue to see with clients is they rely on friends of friends who can tell you whether this guy or this gal is trustworthy. And what we've been doing a lot of in my firm is doing very intensive field level, 360-degree, on the ground, anonymous inspections and investigations of who a legal entity or who a natural person is. And we have discovered in some cases that the people who were being ruled out as being nefarious, in fact, when you did the work correctly, in fact, were actually not as nefarious as made out. In some cases, they actually had done nothing. And that created tremendous market advantage for one of my clients. And on the other hand, we've had situations where the investment bankers, the private equity guys were telling the corporates, go ahead and pull this trigger. We've already invested a lot of time and money doing the due diligence on this. And then we were called in to actually look at the underlying books that are part and parcel of the firm that was being acquired. And lo and behold, we found some very troubling things. And we are not in the business of advising whether you should buy or sell or invest or not invest, but we basically told them, here's what we found. And they did not go ahead with the investment, which is usually not what a consultant likes to see, but this is the way that we work. And lo and behold, 6 months later, the rotten apple that we had found came to light, and that firm was very happy that they never went and made and consummated that investment. So dealing with corruption risks in emerging markets, and I can't tell you which emerging market is more corrupt than another. And I think anyone, frankly, who pretends to tell you that they can tell where is there worse corruption than others, other than extreme egregious cases, I don't think they know what they're talking about. One last thing I want to say before I close, and that is emerging markets, and in particular Africa, one of the biggest fundamental changes that we are seeing, which changes the opportunity-risk trade-off, is the turning of its head of the product life cycle. There are now inventions that historically might have come from the advanced countries under this product life cycle model and then became dumbed down and diffused to middle-income markets and then commoditized to the emerging markets, going back in the 1950s, 1960s, and 1970s. Now, M-Pesa, mobile money, is a classic example, and there are others that are beginning to happen. Inventions are beginning to occur in emerging markets, and now, 6, 7, 8 years later, after the discovery and invention of M-Pesa, you've got Apple and Google saying, oh, we've invented this mobile money machine and technology, without recognizing that inventions actually can take place in these markets. And the lesson there, it seems to me, as investors and as government officials trying to entice investment, is to try to harness the demand, the latent demand, and frankly, the absence of vested interests, the absence of obsolete technologies that you otherwise have to battle in advanced countries, that places in Africa and emerging markets in general are great test beds for thinking about new products and new processes and services. So let me just close here. I hope that I've put a fair amount of ideas on the table. I hope that in some sense they might be provocative, and they are intended, both for industry as well as for governments in the mining sector in Africa and in general in emerging markets. And I hope that they're going to generate some thoughtful discussion and maybe even debate. You can tell, I think, from the way that I've been talking in my presentation that I'm rather bullish on emerging markets. And I think, as we've discussed, the cycle that is part and parcel of commodities, just like the elections cycle in the United States, is not going to change anytime soon. And so the question is, how do you use these kinds of opportunities and de-risk the kinds of risks I've talked about to take advantage of the opportunity or the situation that we're now in to position yourself to prosper in the future? There is no point in fighting what is a force that is much larger than any of us, either alone or together. But this is the time, it strikes me, to take some very tough decisions. But I am bullish on the emerging markets, and I've worked in virtually all of them, from Myanmar to Russia, to Latin America, and of course, Africa. And it's unmistakable to me when I think about my work, particularly in Africa, but in emerging markets more generally, but particularly in Africa, that the economic genie is out of the bottle here. And I think it's something that many policymakers and investors don't yet quite understand. And so the challenge is to let that genie do his or her magic, and don't try to constrain him or her or shape him or her, but listen to what is needed in the governments, to listen to put yourself in their shoes and figure out exactly how to optimize your investment, optimize your operations. If done correctly, you can run very profitable, perhaps even exceptionally profitable operations in Africa, and at the same time, better the economic development of the countries. Thank you very much.